Good evening, I'm John Batchelor. This is the John Batchelor Show. My colleague and co-host, Gordon Chang, the Daily Beast. He's with me. He's at my affiliate in the nation's capital, WMAL. A very good evening to you, Gordon.
Good evening, John.
We have remarks by the chair of the Federal Reserve and other distinguished governors today that the federal funds rate, the best rate, is going to remain as it was the day before, status quo ante. This is significant in that the markets are all watching to see if the U.S. is sluggishness turning down after the buoyant promise of the increase of a quarter point in December. Suddenly we're stalling. But you lead me to believe, Gordon, that our troubles and our doubts about our economy pale compared to what is going on in China, especially with something called capital outflow. What is that, Gordon?
Well, last year, according to Bloomberg, capital outflow was $1 trillion. According to our friend Ann Stevenson Yang of J Capital Research, it was $911 billion, and probably has a more carefully calculated number. But whatever it is, John, it's absolutely enormous, and it's really a signal that this is the end of the Chinese economy as we know it.
So money is fleeing. It's pouring over the Great Wall of China. It's going somewhere else. That's what outflow means.
Absolutely. It's the Chinese people have lost confidence in their own economy. They've lost confidence in their political system, and they're taking their money out of the country as fast as they can.
We welcome Fraser Howie, co-author of Red Capitalism, the Fragile Financial Foundation of China's Extraordinary Rise. Fraser, just a couple of months ago, people were telling me there was a turnaround and the world economy was stabilizing and China was a very good investment and China was going to fix its economy. And then all of a sudden, we hit some bumps with the stock market. That was fixed. And then we hit some more bumps. And now suddenly the money outflow from China is in headlines in Bloomberg. What's happened? Was there some profound issue? Did a comet strike China? Good morning to you, Fraser.
Good evening to you, gentlemen. I think markets are funny things and sentiment can change, and what's happened over the past has been growing, but over the past months and certainly in this year especially, there's really been a realization that things are not going well in China, and that wherever you look, there are problems. You could have looked at the stock market crash and say, the stock market isn't really the economy, it doesn't really affect us. You could look at the currency devaluation of just a few percent and say it's just a few percent. But when you have $1 billion leaving China and their foreign exchange reserves falling so significantly, that's telling you a real signal about weakness in the economy, confidence in the currency. And ultimately, it's a proxy measure for ultimately confidence in China, the ability to reform and the ability of the leadership to sail a steady path through this time of turmoil. And there is, at the moment, there's very little confidence.
Gordon?
Fraser, you talked about signals. Of course, one signal was yesterday when People's Daily, in a front-page commentary, went after George Soros, who at Davos the week before talked about shorting Asian currencies, not specifically mentioning the Chinese renminbi. But I've heard that in New York there are dozens, and I was put this way, dozens of hedge funds that are now shorting the renminbi. That's indeed got to be a signal about what the U.S. financial community thinks about the Chinese currency.
Well, that's right. I would have to say as well, if George Soros didn't exist, I'm sure we would need to invent him. He's
Absolutely.
the devil incarnate for any government who doesn't want to face economic reality. George and many others are going short the currencies in Asia because ultimately they've been overvalued. In the Chinese case, clearly the currency is overvalued. Certainly the market thinks so. And the bottom line is the government can basically prop up the currency as long as it likes, or as long as it's got reserves to do so. And we've seen time and time again countries who have wasted reserves, billions, tens of billions, hundreds of billions. China's going into the trillions of dollars to try and prop up a currency that basically is overvalued.
Fraser, this sudden running away from China, the lack of confidence in China, wasn't that always there? These are really strange decisions to make all of a sudden. What did happen? The market you toss aside. I mean, we talked about that the last two dips. Everybody shrugged off. It's a gambler's market. Is there some failure that 10 years from now they'll point back to?
I think it's more human psychology and sort of catastrophe theory, as they call it, where ultimately the same sort of set of inputs can give either a positive output or a negative output, and that the sentiment can change very quickly. You see that happen in markets all the time, and that many of these problems that we saw. I remember 20 years ago when I first came to Asia, you would look at countries like Thailand or Indonesia, and you would raise issues about corruption, and people say, no, don't worry, this is how the economy works, don't worry about all these inconsistencies and the poor governance. As soon as the Asian crisis hit, everyone was talking, well, of course it was inevitable because it's poor governance, poor management, corruption, etc. Problems that were known about beforehand are ignored as the growth is rising up, as money's pouring in, and of course that's what China's been on. It's been on this long honeymoon, as it were, of money pouring into China as underlying economics have got worse and worse, and then all of a sudden there's a realization, the party's over, the model's broken, and money rushes to the door.
Gordon?
Fraser, one of, I think, the smartest people about the Chinese economy has said in private comments to me that he thinks that what China should do is a 15% devaluation of the renminbi with immediate draconian capital controls. Do you think that's the best solution for China at the moment, and do you think it would work?
This is the trouble. You've got yourself, and they've got themselves into an absolutely horrible position, and because they refuse to take our advice earlier, if you like. Yes, that would work to some extent. It would shake out some of the shorts without question, because the short has happened. The big fall in the renminbi has happened. The capital controls, which they could probably enforce to some extent, would probably stop the currency outflow. So it would work in sorts, but it would be completely counter to everything they say they're doing. It would also basically have to force the IMF to say, we made the wrong decision back in November. China should never have been admitted to the SDR basket. And it would seem to run counter to much of the financial reform they've at least talked about and have started to implement in small scale over the past few years. I think what they should have done, Gordon, they should have done that 6 months ago in August and bitten the bullet then, rather than have this slow death and this slow crawling down. If you're taking the market by surprise, take it by surprise.
I open with what we can discern of the Federal Reserve hesitating again in its rosy scenario for the U.S. I put that aside, except until you tell me, Fraser, is the troubles, the turmoil, the tumult, the unknown, the devaluation, the capital flow in China, is that coming our way? What goes around comes around.
You could argue that it's already happened through the global financial crisis, and ultimately China dodged a bullet there by this huge debt binge and stimulus that kept the thing rolling for another 5 years and whatever. So yes, of course, American companies are going to be affected, because American companies, of course, are now global multinational companies. You already see even, the sainted Apple is affected with sort of iPhone sales starting to maybe peak or turn down. So yes, it's coming that way. That said, the U.S. economy is far more resilient, far more flexible, far more able to what you would call clear itself, find a level where buyers meet sellers, everything clears, and start over again. The Chinese economy is much more brittle, and the pain is going to be much more severe for China than it is for America.
I just want to follow. We were told that when the housing bubble happened, when it falls apart, people in Florida and Nevada and California will suffer, but not us. Is it possible that when China falls apart, we'll feel good until it comes our way in a ferocious and unexpected way?
It varies. The China collapse, the China hard landing has already played out for many commodity producers. There's no question about that. You look at oil. You look at many of the commodities that China. So it's already played out in many of the commodity country currencies or in the producers themselves, and certainly American companies are caught up in that to some extent. I think, though, that the real difficulty, these are domestic Chinese problems ultimately, and the real pain and the real restructuring happens there. The U.S. has gone through much of that restructuring, is in a better position than it was 6-7 years ago. And of course it'll be impacted. The initial shocks will be tough. There'll be a lot of down days in the market if things get worse in China, but it will be able to recover much better and quicker than China can.
Final question for you, Gordon. What's a timeline for the devaluation to 7? You mentioned 7 for the dollar.
Oh, probably that's going to be sometime this year, but the bottom is probably far lower than that, because when confidence is lost, as it is now, there really is no bottom to the renminbi.
Fraser Howie, co-author of Red Capitalism, he is in Asia, and Gordon Chang of the Daily Beast, he is in the nation's capital, WMAL, in Washington. I'm John Batchelor in New York.